a pretty basic and a beginner sort of a session, or rather a recording on investing during uncertainty. So I mean, look. So today, when you open up any social media website, or if you just open up YouTube or Instagram, there's just a whole lot of information overload. It's ridiculously chaotic. There's just too many people giving out too much advice on where to invest, how to invest, and some have even gone to the extent of recommending stocks on public platforms without even considering how their target audience is. Investing is not one of those exercises where I give you a particular stock to buy and you just buy it. There's a whole process behind it, and knowing what stock to buy is just one part of the process, which in fact is nothing. So there's a big science, there's a big process that goes behind designing your portfolio. And before you even begin doing that, it's important to get the basics right. And there's been this whole trend of do it yourself kind of investing, where people have started to believe, retail investors have started to believe that they can just invest on their own, uh, without taking any sort of help. That is also not essentially the right way to look at investing. So let's just set the context here. um, you know this is just a chart of Nifty 50. uh, you know when we look at what happened to the market right after COVID, you had a big fall during COVID. Sometime in March 2020, Nifty sort of fell by around 20 to 30% in a matter of few weeks. And then all of a sudden, after sort of hitting that rock bottom, it sort of ended up rallying a big time. And after that, we've seen a sharp and sudden drop. And this chart was taken up sometime during the second half of 2021, and that still holds today. Even today, you're seeing what's happening to the market. Nifty, after going to 18,500, has sort of come down to 16,500. Don't want to talk about market levels over here, but the broader point is that after making a massive high after COVID, markets have witnessed a drop, and that's the nature of financial markets. Every recession is followed by an expansion, and every expansion is followed by a recession. Just take any major recession that happened. For instance, the Great Recession of 2008, the global financial crisis. Preceding to that, from 2003 to 2008, we witnessed a massive rally in equities globally. And before the 2003 to 2008 phase, we saw the dot com bubble, where the tech stocks in the US fell sharply. So these are the kind of cycles that the markets operate in, and as investors, we sort of need to drill it down into our mind that if the markets are going up today, sometime in the future they are going to come down. So never extrapolate the current trend of the market to the future as well. So if everyone is optimistic today, chances are that there might be something lurking in the corner which might force them to become pessimistic tomorrow. So, I mean, if you want to become a good investor, or you want to improve your investing odds, just I call this the lazy guide to understanding pricing. Basically, you want to understand how market participants are pricing a particular asset. Now, for instance, when you go to buy a car, or you buy some fancy appliance, there's a set price at which you buy it. And as a buyer, you have an intrinsic valuation done to that particular asset. So for instance, if there's a BMW 5 series that someone's quoting a price of 10 lakh rupees, you think, well, it's a great deal, let me just go ahead and buy it. And why do you think it's a good deal? Because you believe that 10 lakhs is a very low price for this particular car, for the kind of utility and for the kind of benefits that it's giving you. And the similar analogy can be extended to the stock markets as well. You know, even in the stock markets, there might be phases when when a really good company might be available at a very good price due to some temporary problem that might be going on. So, I mean, one needs to understand how market participants have collectively priced an asset, or in the case of stock markets, how have they collectively uh, priced the particular company. Now, for instance, tomorrow you might go into the market and you decide to buy a BMW car. So there might be a seller. There might be some minor problem in one of the tires or in the exhaust of the car, which could be fixed pretty easily without taking too much effort. But because of that one minor problem, no one in the market wants to buy that car. As a result of which, something which would have sold for say 30 lakh rupees is getting sold at 10 lakh rupees, and you think it's a great deal, and it indeed is. You just need to work on some minor defects here and there, and you've got a perfect car in no time. And that's how things work in the stock markets as well. The best time to buy a company is when it's going through a temporary problem. In such instances, what typically happens is every market participant thinks that this problem is permanent and not transitory in nature, as a result of which they just completely shun the stock. No one wants to buy it. Something which is worth say 1 lakh crore in terms of market value might be quoting at 70,000 crore or 60,000 crore, and that presents you a wonderful opportunity to accumulate a good quality company. Now, for instance, over here, I mean, this was taken way back in 2021, but the analysis and the insights still hold true. I mean, look at ITC for instance. It was stuck at this 200 range for a large part of 2021 and 2022 as well. And then today it's gone up to 360 or 370. But for 8 years, ITC stock gave no returns whatsoever. But during those 8 years, the fundamentals of the company didn't really deteriorate much. In fact, the dividend payout ratio was enhanced during these 8 years. The I think the free cash flows for the company compounded by around 9 or 10% every year from 2013 to 2022. But the fear that the market participants had was that here's a company which is really dependent on cigarettes for its profitability. And at that point of time, the taxation on cigarettes and tobacco products was going higher. So as a result of which, what the perception was, hey, the taxes on tobacco is too high, so people might not consume tobacco in the future, or rather, the growth rate in this industry is pretty low. And at the same time, uh, with people not really adopting these cigarette products, the profitability of the companies is under question. But I think one of the fallacies of that argument was typically for sin goods like tobacco or alcohol, even if you increase prices, people it's not a deterrent for people to stop consuming them. And ITC has built a monopoly in the tobacco, or rather cigarette industry. So no one would want to enter the tobacco market because it's so regulated. You cannot advertise cigarettes in the market. So no one wants to enter the industry. And you have a company which has a complete monopoly over the industry. And in fact, what was happening during this period is, so each time the government raised taxes on cigarettes, ITC increased the cigarette prices by an even larger amount. Like, so for instance, if the tax on cigarettes was 2 rupees, ITC used that to increase the end price of the cigarette by 3 rupees or 4 rupees. So the tobacco division actually posted improved margins for ITC during this period. So there was no reason for someone to stay away from the stock given the market fear. And I'm not even talking about their IT division or FMCG division, which most people were betting big on. Like so most of the market participants thought that the FMCG division of the company is coming into picture, so the dependence on tobacco would go down. I had a different thought process. I thought, let FMCG and the IT be the icing on the cake. The cake itself is pretty good, and it's going to do well. And the cake over here is obviously the tobacco division of the company. So the broader point is, you need to understand why are investors not taking a liking for a particular stock, and then sort of look into the reasons, if those are good enough reasons for you to stay away from the stock. I mean, there might be a situation where the company is not following ethical business practices, or they might be fudging their accounting numbers, and in such cases, market participants shunning the stock is a fair assumption. I mean, look, the problem over here, once again, for if you're a retail investor or uh, an investor in general, um, is the first is the asset allocation decision. You need to first come up with what percentage of your money goes into debt and what percent goes into equity. Now, debt are financial products that guarantee returns to you. Like a fixed deposit guarantees the returns to you. If you invest in government bonds, the returns are guaranteed to you. To a large extent, if you invest in in company bonds and company debentures, in most cases your returns are guaranteed, but there's always the risk of default. So this offers you a margin of safety. That money is not going to go bust. In the case of equity, if you choose the wrong company or the wrong stock, you might see your entire capital getting eroded, but the returns that you're going to make on equity is going to be far higher. But then, as an investor, you need the optimal combination of returns as well as of risk. So the allocation decision is dynamic based on where you are. So, for instance, if you're a young person who has got no dependence on them, you can actually take a far higher allocation to equity. Whereas you might be pretty young, but then you might have a lot of dependence on you. So, in such cases, you don't want to be taking a lot of risk. So, the allocation decision is not a very simple 70% equity, 30% debt, or the most common or and the lamest analogy I've heard is 100 minus your age should be the allocation to debt. 100 minus your age should be the allocation to equity. These are not uh, the wisest ways to allocate your money. So I mean, yeah, just before wrapping up, I wanted to keep it a very short session. I mean, over here, we sort of look at the mistakes that we make, and these are the most common mistakes that I've seen a lot of investors do. Is they just sort of buy mutual funds that have done well in the past. So during 2022 or 2021, most investors I knew who just entered the market at that point ended up loading their portfolios with IT funds and pharma funds, and things haven't been great after that. Or you end up buying the most discussed or hot stocks, like I think the internet stocks, or the new economy stocks, like the internet based Nikas, Zomatos, and Paytms of the world were really popular, and some people ended up applying for their IPOs. So people don't question the investments that they make. I mean, the question is, you need to ask is, why am I buying this particular mutual fund? What are the constituents, or what are the companies that are part of the portfolio? And when do I want to exit this particular investment? I mean, these are questions that we need to be delving into greater depth, which would be done in the subsequent sessions. And I hope that you got to learn something from this, and any form of suggestions are always welcome. Yeah, thank you.